Thank you very much, and thank you for the introduction. I hope I switched this on. I hope people can hear me. Otherwise, just type in the chat and let me know if you can't hear what I'm saying. Oh, right. Okay. Well, thank you very much for inviting me over and for having me here at this workshop. Maybe in case you're wondering about my accent, I have a British dad, a German mum. I grew up between Germany and the north of England, so I presume I have my very own English accent. So the topic I'm presenting today is joint work with my former PhD student, Fabian, who's now assistant professor at the University of Halle. And when I was invited, I was thinking about, well, what could I speak about to an audience interested in wealth management? And I did some work on tail risks several years ago, but this is a more current topic. And it's still a little ongoing. I'll give an outlook at the end. And I thought, well, correlation is always interesting, right? For anyone in finance, at the end of the day, it's about correlation. And I'm still surprised when I look at the work we've done that this hasn't been done before. So, so maybe something new here. So first, a question to the audience, and I'm inviting the audience online to join as well. If somebody asks you to do correlation stress testing, what do you think are the main challenges?
Reasonable scenarios, maybe.
Okay, reasonable scenarios. Right. Yeah. What does it actually mean to? Right. Yeah. Okay. Yeah. So maybe linking an economic scenario to correlations.
Yeah, exactly.
Right. How do you do the link? Okay. Dimensionality. Okay. Yeah. Yeah. Yes. Okay. Regime switching. Okay. Yeah. Okay. Yes. Yeah. How does correlation change? Right. It's dynamic. It's non-stationary.
Using the current.
Right. Yeah. How do you make sure you get a positive semi-definite matrix if you bump correlations? Okay. Yeah. Anything? Yeah.
When incorporating existing methodology and
Okay. All right. So you already have a model, and now you want to.
tweak the model that's already.
Okay. 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 That's an interesting question. I don't have an answer to that one, but maybe that's something we could discuss later on. Okay. Yeah. Okay. So yeah, I mean, here are some of the answers I've gotten in the past when I gave this talk, and it's more or less what you covered. So linking risk factors or scenarios to correlations, identifying risk factors, how to obtain a valid correlation matrix. I think in line with identifying risk factors is also how do you find plausible scenarios? So something that is extreme, but still deemed possible, right? And then usually there's somebody who says correlation is bad. We should use something more advanced. But my experience is when speaking to practitioners, they say, well, we're already have a hard time tackling correlation. So copulars is like if you have maybe 3 components in your portfolio, but if you speak of a proper portfolio with a high dimension, then correlation will need to do. Okay, so the goal of what we're doing, or what we did, was to link meaningful scenarios to changes in the correlation matrix. And there are 2 papers. The first paper, I will kind of introduce the methodology using that paper, was published a while ago in the Journal of Banking and Finance. And this focuses on an incident in the finance industry called the London Whale. And we took the London Whale incident because it lent itself so nicely to developing a method for correlation stress testing, as you will see. And then once that paper was out, we were invited to the ECB and to other regulators and to the finance industry. So, well, the first paper is very specific, tailored to that case. And the question was, how could this be generalized for arbitrary portfolios? And that's when we sat down and then generalized the approach. So I'm going to speak about that in the second part of my talk. In both papers, we focus both on stress testing. So specifying a scenario, an adverse scenario, and then figuring out how does it affect a portfolio. But we also ask the inverse question: what is an extreme but plausible scenario that is more or less the worst case for my portfolio? And personally, I think that's maybe the more interesting question. I'd be interested to hear your views about that. I mean, when I look at my own portfolio, I sometimes think, what's the worst case scenario for my portfolio? What is it that I need to watch out for? So we're trying to give an answer to that as well. Okay, so here are just some quotes from EU regulatory documents. So requiring financial institutions to do stress testing, reverse stress testing, identifying basis risks and hedging, which is also closely connected to correlation, as we will see in the London Whale case, assess concentrations, have a model for correlation trading. So it's also something that financial institutions need to take care of. Okay, so I don't know how familiar you are with the London Whale case. It refers to a loss at JP Morgan in 2012 that eventually amounted to approximately $6.2 billion US. It was a loss on a credit derivatives portfolio. And the special thing about the London Whale, if you compare cases of losses of that magnitude, is that it was an authorized trading position. So we're not talking about fraud or criminal actions, but it was a trading position that was monitored by risk management. Although not in the investment bank, it might have been treated differently if it had been in the investment bank. But that makes it special. And for our purposes, it's a nice case to study because it's purely a credit derivatives portfolio of highly correlated credit derivatives. It's a large position where the individual components were supposed to hedge each other, but there's basis risk and always the risk of correlations breaking down and those internal hedges blowing up. So the portfolio consisted of approximately 120 long and short positions in the CDX index and the iTraxx index. CDX is the North American credit derivatives index and iTraxx the European counterpart. And it contained both just index products, securitized products, so tranches, investment grade and high yield. And at its peak, its size was net notional roughly 157 billion US dollars, which was a sizable part of the market. It was initially installed, it's called the SCP, the synthetic credit portfolio. It was initially installed to hedge certain risks at JP Morgan, but then it kind of developed a life of its own. It was very successful for many years. So I suppose the traders were given certain freedom in their trading. So they implemented something they called the smart short strategy, which is credit protection on high yield being financed by, so buying protection on high yield by selling protection on investment grade indices. And just a brief timeline, at the end of 2011, there was a decision to reduce the risk-weighted assets in the portfolio. And instead of liquidating positions, which is one way how you can reduce risk, it was decided to actually increase positions by hedging. And that was end of 2011. And then in March, end of March 2012, it was ordered to stop trading on the SCP, which had gone up sharply in terms of net notional. And the data we have and the position that we know of is on the 23rd of March 2012. So this is what we're going to focus on. We don't know the details how it developed, but that's of less importance for what we're going to do. All the information we have is from publicly available documents, and at least what's publicly available in terms of information is that risk management was focused on value at risk, but assuming that all the parameters are constant, and a credit spread widening of 10 basis points. So just bumping all credit spreads by 10 basis points and then looking at the differences. I'd be surprised if there wasn't more going on behind the scenes, but this is what we know from the publicly available documentation, right? So there's correlation risk, quite obviously, in the strategy, and both in the reaction to offloading risk from the position. So it's a nice setting portfolio to study correlation risk and correlation stress testing. Okay, so that's just the timeline of the losses and the 10 largest positions. I won't go through this in detail. You'll find it in the slides in case you're interested, just to give you an idea, in case you are familiar with the markets. So for example, we have 10, 7, 5 years CDX investment grade, index products of series 9. There's a new series every 6 months, I believe, both seller and buyer positions. And then we have iTrax, the European index, some of them index, some of them tranched products, and so on.
So untranche means it's the full index.
Tranche means it's untranched is the index, yes. Yeah. Just the simple index. Okay, so I mean, the London whale case has been studied in, yes.
Another point on raised that all these, because the study is about concentration.
Yes.
Most of positions they by simple data.
Yes. Yes.
I'm wondering whether this plays at all.
Right. Okay. So, I mean, the London whale case has been researched from different perspectives, and of course, liquidity or risk or liquidation risk is one of the major sources of risk as well, that at least as far as the publicly available documentation goes wasn't accounted for. But quite obviously, that's one of the things you would need to look at is liquidation risk. And that's been done. There's a paper by Ramakant where he looked into that. It's somewhere in the slides as well. And the other obvious risk is correlation risk. Yeah. Okay, so the liquidation risk had already been researched, and we thought it'd be nice to look into the correlation risk. And our idea was to borrow methods from interest rate modeling about the parameterization of correlations. So if you are familiar with market models, for example, the LIBOR market model, you will know that there are parameterizations for volatility and for correlation. And the reason being as follows. In a labor market model, you model maybe 20, 30 forward labors, consecutive forward labors. They are highly correlated. So you have a high dimensional model with all these highly correlated forward labors. And if you didn't use parameterizations for correlation and volatility, you would just have a huge number of parameters to calibrate. So both for volatility and correlations, people use parametric forms. The simplest parametric form is this one here, which says the correlation between two forward labors with maturities I and J is given as the exponential of minus beta, and that's a parameter to be calibrated, and the difference in maturities. So there's one parameter beta for all forward labors, right? So that's for all I and J. And that captures the fact that, so beta being a positive parameter, that there's a decorrelation the further apart the maturities. So if you have like, I don't know, 5 and 6 year LIBOR, they will be highly correlated. If you have 1 and 10 year LIBOR, they will have a much lower correlation. And that's the simplest. There are many other parametric forms, but that's the simplest one. And we thought, well, maybe we could borrow this idea and adapt it to the London whale. So the idea being that this distance measure could be applied to other risk factors, right? So, for example, in the London whale case, let's see if this, in the London whale case, we would have the geographic regions. Credit derivatives differ in their geographic regions, North America or Europe. Investment grade versus high yield. In a general setting, it could also be interest rate, industries, etc. So the idea would be to determine a number of factors that apply to each security, denoted here by a vector X, and then build a model for correlations similar to the one from the labor market model, but now kind of having several of those risk factors. And those betas, again, they would just be determined by calibration. Right? So the closer to credit derivatives are, or the closer to securities are, the higher they will be correlated, and the further apart they are, the less they will be correlated. And if two instruments are identical in all of these risk factors, their correlation will be 1. It's something that we changed in the second part. And then this is very easy to calibrate. So if you have a snapshot of a correlation matrix, so you estimate empirical correlations, then you can just use some least squares optimization to find those betas. Right, so ordinary least squares on those log correlations. And once you have the beta parameters, you can bump them. And if you do that on a regular basis, like every day, you will have a parameter history of those betas. And that gives you some indication of what are typical scenarios, what are extreme scenarios, etc. Yes.
You have the industry instance.
Yes.
How do you measure distance between industries?
Okay, I'll come to that in the second part of the paper. We didn't do it for the London whale because that's kind of a tricky thing to do, but we found a solution then in the second paper. The only thing that needs to be taken care of is if you make changes to the betas, that both the calibrated correlation matrix and the bumped correlation matrix are positive semi-definite. They are most of the time, and if they're not, it's usually easy to find a close correlation matrix that is positive semi-definite. So that's not a major challenge. Right, so for the London whale, what we took as risk factors were CDX versus iTrax, investment grade versus high yield. So those are dummy variables, the maturity index series, and another dummy index versus tranche. So this is the parametric form of the correlation matrix. This can be 0 or 1, this can be 0 or 1, this can be some natural number, and again 0 or 1. So we did a daily calibration. So for every day in our data, ranging from early 2011 until end of Q1 2012, every day we calibrated an empirical correlation matrix from 250 days, and then we calibrated those betas. So let's see. So here's an example. Here we have an empirical correlation matrix. Those dark red lines, they are just missing data for various reasons. So that's the empirical correlations of 23rd of March 2012. And here we have the fitted correlation matrix. Here we have CDX investment grade, CDX high yield, and iTrax, those three big blocks. Right, and we did that every day on our data set, giving us a timeline of those betas. And remember, the higher beta, the smaller the correlation, the higher the decorrelation, because it's e to the power of minus beta. And the most interesting thing that can be seen here is this investment grade beta. That's the blue line, which starts out low and increases steadily over time, meaning there's a decorrelation between investment grade and high yield. And if you remember, investment grade and high yield were supposed to hedge each other. So we clearly see how that hedge over time fell apart. So yeah, here's that paper by Ramakant and his former PhD student who looked into liquidation risk and also correlation breakdown after trading was halted. But we can see it was already ongoing while the portfolio was still active. Okay, so how can that be used to stress test correlations? Well, the first thing to observe is that if you bump correlations, it has no effect on the value of a position. Right? I mean, so what we need to do is we need to define a stress test on some risk measure of the portfolio, right? And in the simplest, in the simplest case, we just take a very simple valued risk, but it could be any risk measure. It could be expected shortfall. It could be using other methods, just any risk measure that includes correlation. So here we just have a very simple valued risk as being at a level alpha as being defined through the 1 minus alpha quantile of the normal distribution and the standard deviation of the portfolio, where the weight center and the covariance matrix. So for the correlation stress test, we actually just need to look at the portfolio variance. And there are a couple of theoretical results on homogeneous portfolios in the paper that I'm going to skip. So let's move forward and have a look at the results. There's a standard, very simple methodology for stress testing, which takes into account correlations between risk factors. So there's a set of core risk factors that are being stressed. There's a set of peripheral risk factors, those that are affected by the stress, and then through conditional expectations, it's easy to work out the effect of stress on the core risk factors, their impact on the peripheral risk factors. And finally, because correlation shocks often coincide with volatility shocks, we also included volatility shocks by specifying a model where the constituents of the portfolio follow a multivariate t distribution. A multivariate t distribution can be decomposed or is a special case of a so-called normal variance mixture distribution, which can be decomposed into something standard normally distributed. A matrix that where correlations enter. So it could be something like a Cholesky decomposition, and a scalar random variable that scales the whole thing, and that would be the volatility shock. So we can do correlation shock here and the volatility shock there separately. Okay, so and before we go into the results, the last thing I would like to introduce in terms of methodology is the reverse stress test. Yes.
The core risk factors and the predicted risk factors, do they correspond with systematic and idiosyncratic?
No. So you have the set of risk factors. For example, we had North America versus Europe, investment grade versus high yield, etc. And if you say you do a stress on investment grade versus high yield, then this is the core risk factors, and all the other risk factors are peripheral, right? But the risk factors, that they are correlated as well. So if you stress one of them, you have to calculate the impact on the other risk factors. It's the one that you specify in your scenario, and the peripheral is kind of the others, and you need to define the spillover onto the others. Yeah. Okay, so let's briefly talk about reverse stress testing. So the question is, what is the worst scenario that can hit my portfolio? And we want the scenario to be plausible, so we need to narrow down the set of candidate scenarios. And one way to do it is with specifying a probability. So within some probability range, we include all the scenarios as plausible scenarios, and outside of that range, we say it's implausible. In a univariate case, it would just be a quantile. You would say anything up to the quantile would be deemed plausible, and anything beyond would be deemed implausible. So you can think of this as being a multivariate or a generalization to several dimensions of quantiles. So one measure in when working with elliptical distributions, the normal distribution being kind of the most prominent candidate of elliptical distributions, is the so-called Mahalanobis distance. We already saw terms like this yesterday in Stavros' talk. So it's kind of the distance from the average relative to the standard deviation, or relative to the variance. And what this means is that if we limit the Mahalanobis distance, it basically means we select one ellipsoid here, and we include everything within that ellipsoid, and we exclude everything outside of this range. And then we ask the question, what is the worst scenario for our portfolio? What's the highest valued risk within these plausible scenarios? Okay, so let's have a look at some of the results. So we're looking at a 99% daily valued risk on, doesn't say the day, but it's that 23rd of March 2012, because that's the day where we have data. And the valued risk normally distributed is 339. I believe it's millions. I have it on here, $1 million. And the t-distributed valued risk is 355, roughly. So if we now include correlation stress at kind of different levels, and we're looking at the worst case, then we see how the valued risk increases. If it's unconstrained, it increases by 83%. If it's constrained, it increases by somewhere between 9 and 14%. When we first saw those numbers, we were actually a bit surprised. We'd expected something much more spectacular, but then we realized, I mean, this is after the stress scenario has actually been realized, as we will see in a minute. Yeah, so it would have been interesting to do this on the portfolio maybe a year before, right? But this is kind of on the day when the risk had already materialized and when they stopped trading. If we include volatility stress, then we see a much stronger appreciation. So there's still room for volatility stress scenario. Let's have a look at the reverse stressed results. So what you see here are the 5 risk factors: CDX, investment grade, maturity series, and whether it's an index product or a tranche product. And you see box plots of the betas of the correlation parameters. So the betas that before you saw as a time series are now shown here as box plots. And within those box plots, there are 2 markers. So the dots are the parameters observed on the 23rd of March, 2012. And the crosses correspond to the worst case scenario under a 99% Maha distance. Right, so the crosses are the outcome of the reverse stress test, and the dots are the actual parameters of that day. And what we see is there's for all risk drivers, there's still room towards the worst scenario, except for the investment grade versus high yield parameter, where we see that scenario has been realized. And that was probably the main driver of the portfolio, because that was the hedge they had installed, right? Which also explains why we don't see a stronger appreciation in the value at risk figures, because this has already been reached. Okay, so that was the London whale, and that was easy in the sense that we had this quite homogeneous set of securities with very clear properties. So we could say, well, these are the risk factors, and then play around with it. So that was fairly straightforward to do. And then the question was, well, how do you generalize? I mean, what do you now do if you have a portfolio of stocks and you have firms, and how do you define risk factors? How do you associate them, link them, etc.? So let's have a look at this. So the idea would be to carry over the principal idea of this distance measurement, but include further risk factors. And what we'll do is we will have assets denoted by an index I and risk factors denoted by K. And for each risk factor and asset, we will have a variable that is either 1 or 0. So saying an asset is linked to a geographic region, or it's linked to an industry, or it's not. Right? And I'll speak about how we come up with these in a minute. We made refinements to the correlation parameterization. So first of all, we use this tangents hyperbolicus. So we have a correlation function that is monotone, increasing in its arguments, which is kind of easier to to understand. We include a constant so that securities that are identical in all respects can still have a need not be perfectly correlated. And then we have both intercorrelations and intracorrelations. Intracorrelations means, so as we iterate over the risk factors, two assets I and J are linked if they are both exposed to the same true risk factor K. That's the intracorrelation, so they're in the same bucket. The intercorrelations are those between buckets. So two assets are linked, I and J are linked if they are not in the same bucket, if they don't share the risk factor K. And then we have eta as the constant, lambdas for the intercorrelations, and news for the intracorrelations. And one of the nice things about this tangents hyperbolicus is that roughly, very roughly, we can, using this approximation, so if this is small enough, then the sum of the tangents hyperbolicus can be approximated by the sum of the two tangents hyperbolicus, meaning if very roughly the sum of the etas, lambdas, and news will give us some indication of the correlation between two assets. Okay, and then it's stress testing as before. You would bump lambdas, you would bump news, whatever, and with parameters calibrated on a regular basis, we have a parameter history, and we can use that for obtaining plausible scenarios, doing reverse stress testing, etc. Okay, so how do we assign factors to securities? That's really the tricky question here. And what we do in our application is we use industries and countries as risk factors, which I believe is fairly standard. And the goal is to link companies to industries and countries. Now, it's fairly easy to link a given company to one industry in one country. It has a primary industry. We use the JICS classification, and for every country, there's one industry that we can link it to. If you take VW, the automotive company, then it's clearly an automotive company. And we can also take the country's headquarter, the firm's country of its headquarter as a country. But at the same time, if you think of a company like VW, in a sense, it's a German automotive company, but in a sense, it's also it also has a finance subdivision. It's an internationally operating company, so it's much more than just a German automotive company, right? So we would like to include more factors, but we don't want to include too many factors, because if we include too many factors, then we lose the interpretation of what differentiates companies and what does it mean to stress one particular risk factor. So we would like to assign a number of small but important risk factors. So one way to do this, if we had no prior information, could be to use a method like lasso, which is kind of a bit like regression, but with a regularization constraint that will set a lot of the coefficients to 0. And that's a very good variable selection method. If you just use ordinary least squares, you do regression, no parameter, no coefficient will ever be 0, right? But with lasso, a lot of them will drop out. However, we do have some information, prior information, that we would like to include. So we don't want to keep our fingers crossed that lasso will detect that prior information, but we want to explicitly include it. And then a kind of generalization of lasso in a certain sense is Bayesian variable selection. So with Bayesian variable selection, we can, so we use Bayesian model selection. We can specify the average number of risk factors that we would like to include. And then the method will find the model out of a set of candidate models that kind of has highest probability, conditional on the observed data. And model in that setting means you have all the combinations of models where risk factor is switched on or off. That's a set of all models. So I'll skip the details because we don't have time to go through it and it's not that important, but maybe to give you an example, if we, for example, pick VW, we have daily returns over 16 years in this example. We use as risk factors MSCI index data. We have 11 industries, the GICS industry, 24 countries as factors. And then we have the prior information. So primary industry, primary country. We specify that we would like to include 8 factors on average, and then Bayesian variable selection will include a number of further factors. For example, we don't have finance in here. We have, is that utilities? We have Austria, so we have a number of further factors included. Okay, so the method then is again the same as before. So we use valued risk as our risk measure. That's unchanged. We slightly extend the setting regarding what was before the beta parameters, which are now the eta, lambdas, and nus. So instead of using the Mahalan-Obis distance, which just focuses on ellipsoids, we switch to something called highest density regions, which allows for more freedom regarding the multivariate distribution, because these factors are never normally or elliptically distributed. They are skewed and so on and so forth. So the highest density regions approach allows for more flexibility in that regard. So the way to think of it is, if this is the density of your data, you find a line such that a certain amount of certain probability mass is above the line, and this then specifies your highest density region. And then within the highest density region, we just find the valued risk as being the scenario, the risk factor scenario that maximizes valued risk. Okay, so let's have a look at some results. So in our final paper, we used the 11 GICS industries. We used only 6 regional indices because we use only DAX and S&P data. So we reduced the number of geographic regions. We use nearly 20 years of data. This is wrong. In fact, we did extend the data because we have COVID in there as well. So it runs until 2020, I believe, or 2021. We recalibrate the factor assignment, the Bayesian variable selection, every quarter because it might change over time. But we do it in a smooth way. So for a new factor to be recognized as a factor and for an old factor to drop out, we put certain constraints on there. We hard code the primary industry and the primary country, includes 6 factors on average, and then everything is calculated on a daily rolling time window of 250 trading days. Yes.
Does it select the same factors for all equities, or does it do it like for each?
For
stock
each
differently?
individually. So for example, if you take SAP, big German IT company, and we have, how many quarters do we have? 88 quarters. So you see in 88 quarters, it has Europe and IT hard-coded. And then here are the kind of additional risk factors assigned to SAP, varying over time. So roughly half of the time, it's also consumer discretionary, consumer staples, sometimes utilities, and so on, right? It's never real estate, not surprisingly, never financials. So that's SAP, and then we have Amazon, which is America's consumer discretionary, hard-coded IT, because it's also a very large IT company, is very strong in Europe. So this is selected most of the time, and then you see it's never energy or utilities or healthcare, not surprisingly. So we do that for every single company. That was at the beginning of the COVID pandemic. I don't know, there's not so much to see here aside from they have some similarity. So let's have a look at some of the factor coefficients. So we have Americas, and so inter and intra Americas over time now, the calibrated factors. So 1 lambda, 1 nu. Intra America refers to companies that are jointly, the correlation that where they are jointly assigned to the Americas factor. And then we see how obviously the subprime crisis kicks in. We see COVID, quite obviously. Let's see, what do we have here? Here we have, again, Americas. The other factors are not that strong. I presume here this would also be some of the crises in Europe, but a lot of the European companies have Americas assigned to them because they operate internationally. So, yeah.
Can you say again, what is this?
Okay, so that's the geographic risk factor for Americas. So it's a stock index on an American portfolio. And so let me go back to this one. So here we look at intra-Americas, that's the orange line, are the correlations amongst American companies. And these are correlations amongst American and non-American companies, right? Or companies that do not have Americas assigned as a risk factor. Yes. Sorry, where's the bump in? 2012. What this is? I presume, I mean, this was a time of crisis in Europe. I mean, in the aftermath of the subprime crisis in Europe, we had various crises in, for example, Greece, but also other countries with quantitative easing being applied on a large scale. And I would presume, but I can't tell I mean, this would be the correlation of countries, American countries with non-American spikes up. But I would presume that a lot of the countries that we have in our sample are also internationally operating. So, for example, Amazon is highly linked to Europe, so we see that in there as well. So those are the intra correlations. I want to show the, so this is the valued risk, 1 day valued risk on an equally weighted portfolio on the DAX and the S&P 500. And the baseline, the blue line, is the valued risk, and the orange line is the valued risk based on a kind of worst case scenario. Sorry?
This person is changing, right?
Sorry?
Person is changing variables, yeah.
Sorry, I did. Oh,
Person is changing variables.
yeah. So, I mean, yeah. So we take one particular stress scenario. We don't vary the stress scenario. We take this particular stress scenario, and then we look at the valued risk through time. And we see that there are time periods where the actual VAR comes very close to the stress, correlation stressed valued risk. Same here, right? So, I mean, that's an indication that there's a strong decorrelation going on here, because the actual valued risk is equal to the stressed valued risk under that worst case scenario. And finally, we have the reverse stress test. I mean, this is now kind of hard to interpret, but it's a similar picture to the one that we saw with the London whale, now just with all risk factors and more information. There is, we also include different value at risk calculations. I would say, I mean, the London whale picture is a more interesting one. This is for the sake of completeness, but we don't see these direct interesting effects that we saw before. So I ought to come to an end and conclude, and I want to give a very brief outlook. So we develop a correlation stress testing framework with the idea of linking risk factors to correlations. We show how it can be done for linking industries and countries with correlations. We do reverse stress testing. As an outlook, I would like to kind of develop, or I'm in the process of developing the following idea. So, I mean, here we have given risk factors, industries and geographic regions. But of course, an interesting stress test scenario could also be something like a global stress test. And the question is, how do you implement a global stress test? Now, a very simple approach could be to say, well, on the risk factors, so the geographic regions, industries, let's do a principal component analysis, and let's take the first principal component as a global risk factor. And I've done a study on that data, and you actually see it's nearly always a global risk factor, ex-Asia. Asia kind of has a life on its own. It's usually in the second component. And I tested for discrepancies in times, like, because we use daily data, I tested it on weekly data. So opening, closing times of stock, of exchanges don't play a role. But anyway, so we could use that first principal component as a risk factor. We can also see through time how that risk factor sometimes is stronger and is less strong. So we can also say something about the importance of global risk or the impact of global risk. And I'm right now in the process of generalizing, in the sense that I would like to develop an approach where we reduce the number of risk factors, because generally they are very highly correlated anyway, but we are still able to give those risk factors an interpretation, which we usually can't do in PCA. PCA also kind of gives importance to risk factors, but if I say I want to have 6 risk factors, I don't want to have them ordered according to importance. I want them to, I don't know, it could be something like a global risk factor, then Europe, Asia, cyclical industries and non-cyclical industries. Something that would be 5 risk factors, something like that, and maybe emerging markets, something like that. So they're not ordered in terms of importance. And so what I'm working on is on extending a neural network algorithm called autoencoder, which is a dimension reduction neural network. It can be thought of as an extension of PCA, but modify it in a way that it gives us a predefined number of risk factors or predefined number of factors, and then attempt to give them an interpretation. So that's what I'm currently working on. I was hoping to have a couple of results, but we're not quite there yet, but we're making quite good progress. And I think if we think this further now, not necessarily correlation stress testing, but stress testing in general, I think that area of where we use machine learning algorithms that are very powerful, we need to combine those with the explainability that we need. So we don't want to use black box algorithms, but we actually want to develop algorithms where we have an interpretation and where we know what's going on. Okay, so that's just as an outlook where I'm headed. So I'm still doing some work in that area, but now moving more towards kind of more general settings, but always with stress testing in the back of my head. Okay, so let me thank you for your attention, and I'm happy to take any questions, comments, discussion, ideas. Yes.